If you have a credit card or an adjustable rate mortgage, that means your interest rate changes every so often. It used to be the law that lenders had to tell you on your statement how much your interest rate was. Those regulations have been rolled back, but do a little bit of math, which I'll show you. It's pretty easy. Imagine this is your balance, and this is today. And over the course of the month, you rack up charges. On the last day of the billing period, you have an ending balance. This is the number that is used to charge you interest. And then you are given a handful of time to pay. So the lender calculates your balance, and here's the number you want to look for. Interest charged on purchases. Once you found that number, let's say it's $160.19. We would take the 160 divided by the number of days in the billing period, and this makes a difference. And we get 5.34. That's our daily interest. Multiply that times 365, and we get 1949. Our balance, let's say in this case, it was $10,000. So we divide it and we get 19.49% interest. Now, if you're still confused, just check out my financial analysis course in the description. So let's recap the steps. You find your interest charged on purchases, divided by the number of days in the statement. Take that number, multiply it times 365, and then divide it by your balance. And that's how you calculate your interest rate. This is Trevor. Thanks for watching.